Welcome to the Deep Dive.
Great to be here.
This week, we're taking a closer look at the U.S. stock market, specifically that pretty eventful four-day trading week, April 21st to the 25th.
Yeah, definitely eventful.
We're using the weekly market report from Market Deep Dive as our guide.
Right.
And our mission, really, is to figure out what actually moved the needle last week. What were the key shifts, the driving forces?
And what it all might mean, looking beyond just the daily noise.
Exactly. It felt like a bit of a roller coaster, especially trying to recover from those earlier losses.
It certainly was. A sharp drop, then a strong climb back. Let's try to unpack that.
Okay, let's dive in. Major indexes first. The Dow Jones Industrial Average. It closed at 40,112.98. Ended the week up 2.4%.
Which sounds pretty good on the surface.
Right. But that hides a lot. Monday saw a big drop, didn't it? Down 2.5%.
Yeah, quite a tumble to start the week. Down to, 38,176.74.
So what spooked the market on Monday?
Well, it seems like it was a combination of things. Renewed worries about trade policy uncertainty.
The trade issue again.
And also President Trump's comments directed at Fed Chair Powell. That kind of thing tends to make markets jittery.
Worries about Fed independence.
Exactly. It raises questions, uncertainty. Investors often pull back from risk in those situations.
Makes sense. And even with the weekly gain, the Dow's still down for the year, right? About 5.5%.
That's right. So while last week was a step up, there's still, ground to make up to reach those levels we saw earlier in April.
Okay, now the S&P 500 actually did even better for the week. Closed at 5,526.98, up a solid 4.5%.
A really strong weekly performance there.
It had a similar Monday fall, though, down 2.6%. But then a big 2.5% jump on Tuesday, and it finished Friday strong, too, adding another 0.77%.
Yeah, it clawed back more effectively. It had dipped close to correction territory, so that 4.5% gain pulled it back quite a bit.
It's still down 8.8% year-to-date, but that recovery seems more broad-based than the Dow's.
I think so, yeah. The S&P covering 500 companies gives you a wider picture. Its stronger performance suggests the positive factors last week weren't just limited to a few big names. It had broader reach.
And then there's the Nasdaq. Always interesting. Huge weekly gain, 6.6%. Closed at 17,379.54.
Very impressive jump for the week. Tech really bounced.
But it got hit hardest on Monday, down almost 3%.
Right, 2.9% down. Shows that sensitivity.
And even with that big weekly gain, it's still nursing the biggest year-to-date loss, down 13.4%.
Exactly. That really highlights how sensitive tech stocks are to, the big picture stuff. Trade, economic confidence, interest rates.
But it also shows they can rebound sharply when the news turns positive.
Absolutely. Good news on trade, especially, can send tech flying.
What about the VIX, the volatility index?
Yes, the fear gauge. It actually dropped a bit by Wednesday, fell to 28.94 from over 30 the week before.
So slightly calmer nerves.
Slightly, yeah. But 28.94 is still quite elevated historically. It's not like we're back to calm waters.
Still suggests underlying unease then.
Definitely. A VIX above, say, 25 usually signals that investors are still worried, still expecting potentially big swings, which fits with the week's actual movements.
Okay, so that sets the stage for the indexes.
Yeah.
Now the why. What drove these moves? The report points to tariff policy relief as a big one, especially for Tuesday's rally.
Yes, that seems key. But let's start with Monday's sell-off again. Those Trump comments on Powell.
Right, you mentioned that, creating uncertainty about the Fed.
Yeah, any hint of political pressure on the Fed tends to unsettle markets. It raises questions about future policy predictability.
Then came Tuesday, and boom, total reversal. Reports about tariff exemptions.
Exactly. Reports surfaced about potential exemptions for tech and auto sectors, kind of extending that 90-day pause from early April.
And the market just loved that news.
Oh, absolutely. Anything that suggests reduced trade friction, especially for major sectors like tech and auto, is seen as a big positive for profits, for growth.
But the rally wasn't unlimited, was it?
No, and that's important. China still has significant retaliatory tariffs in place on U.S. goods. That reality likely put a lid on how high things could go.
And Friday was more stable. Maybe hope for actual talks.
Seems like it. A bit of cautious optimism, maybe, that these exemptions could be a step towards broader negotiations, a more lasting solution.
Okay, what else? The Federal Reserve's general stance was still a factor.
It was still lingering, yes. Powell's comments from mid-April about tariffs potentially fueling inflation, that was still baked in.
So the market wasn't expecting rate cuts anytime soon, maybe June at the earliest.
Right. Expectations were pretty muted, maybe only looking for 40 basis points of easing for the whole year.
But by the end of the week, did the focus shift away from the Fed a bit, more towards earnings?
It kind of felt that way. As earnings reports started rolling in, showing actual company performance, that seemed to take precedence over just speculating on the Fed's next move.
So maybe the market started accepting the current rate range, 4.25 to 4.50%?
Perhaps accepting it or at least shifting focus. Fundamental data, like earnings, can become the main driver when it's strong enough.
We also had some really mixed economic signals, didn't we? Durable goods orders, huge jump in March.
Massive jump, yeah, up 9.2%. And commercial aircraft orders were up, what, 139%?
Wow. Trying to get ahead of tariffs, maybe.
That's certainly a plausible explanation. Locking in orders before potential cost increases. Strong retail sales growth, too, 1.4%.
That sounds positive. But then, other data wasn't so great.
Not at all. The Empire State Manufacturing Index was really weak, near a record low at minus 8.1.
Ouch.
And consumer sentiment hit a 32-month low. So you have strong orders and retail, but weak manufacturing sentiment and consumer mood.
That sounds like a recipe for confusion. Maybe those stagflation fears.
Precisely. Strong past activity or orders, but weak current sentiment in manufacturing. It feeds into that narrative of potentially slowing growth alongside sticky inflation. That likely added to the negative mood on Monday.
But then earnings season seemed to ride to the rescue.
To some extent, yes. About 73% of companies that had reported Q1 earnings beat expectations. That's a pretty strong beat rate.
Especially in tech and financials.
Those were key areas, yeah. And importantly, the guidance, the outlook from companies, particularly chip makers and banks, seemed pretty upbeat.
So good earnings helped offset the trade worries and maybe encourage some buying.
I think so. It provides a fundamental underpinning. When you see companies actually performing well and expressing confidence, it can counter those broader macro fears, at least temporarily. Encourage buying in stocks that got hit hard on Monday.
So it was this real tug of war all week. Trade fears versus earning strength.
Exactly. And Tuesday's big rally suggested that, for a moment anyway, cautious optimism based on fundamentals and potential tariff relief won out.
Okay, let's break it down by sector. Technology, obviously a big beneficiary of the tariff news, up 3% for the week.
Yes, driven heavily by that chipmaker rally once those exemption reports came out.
Software firms recovered too.
They did, yeah. Broad strength in tech, but you still saw those intraday swings, reminding everyone that trade risk hasn't disappeared.
Financials also had a good week, up 2.5%.
Helped by those strong bank earnings, like we mentioned, and also solid March job growth numbers, 228,000 jobs added.
Good for banks, good for the economy generally. Regional banks did okay too.
Yeah, they seem to outperform a bit, perhaps benefiting from being less directly exposed to international trade issues compared to the money center banks.
Consumer discretionary, up 1%, supported by retail sales, but autos lagged.
Makes sense, right? Strong overall consumer spending helps the sector, but specific parts like autos are directly in the line of fire if tariffs hit hard on components or finished vehicles, so pressure there.
Utilities and consumer staples also saw gains, about 1.2% and 1% respectively. Defensive plays.
Classic defensive buying, yeah. When uncertainty is high, investors often rotate into these sectors for their stability and perceived safety, predictable demand.
Healthcare was the odd one out, dipping slightly, about 1%, still under pressure.
Yeah, it seems to be carrying over some pressure from previous losses and some big names within the sector. There was some recovery late in the week, but overall it lagged the market, maybe sector-specific concerns weighing on it.
And the Russell 2000, small caps.
They actually did quite well, climbed 1.41% to 1,916, outperformed the large caps.
Why is that, do you think? Less trade exposure.
That's the likely reason, yeah. Small cap companies tend to be more domestically focused, less reliant on international supply chains or sales, so they're somewhat insulated from the direct impact of tariffs. Investors seeking refuge, perhaps.
Makes sense. Let's look at a few individual stocks that made waves. Apple.
Apple got a 2% lift on Monday after those tech tariff exemption reports surfaced, helped its supply chain concerns, finished the week up 3%.
Still down a lot for the year, though, like 17%.
Yeah, it's had a rougher year, but that week was positive. Nvidia also had a decent week, right?
It did, gained 3% midweek, even after flagging a pretty big $5.5 billion charge related to China export restrictions, ended the week up 2%. Shows resilience.
Strong demand for their chips, clearly. JPMorgan Chase.
Big one for financials. Climbed 3.6% after really strong Q1 results. Helped lift the whole sector. Ended the week up 2.5%.
Shows the power of strong earnings And Boeing.
Boeing had a rougher start, fell initially on the U.S. China tension talk.
Right. Very sensitive to that relationship.
But it ended up closing flat for the week as those potential aviation tariff exemptions came into the discussion.
So these specific stock moves really just mirror the broader themes, don't they? Sensitivity to trade news, the importance of earnings.
Definitely. Okay, shifting gears slightly. What about the bond market?
Still saw steady demand for safety. The 10-year Treasury yield actually dropped a bit over the week, ending around 4.385% on Wednesday, down about 0.09% for the week.
So even with stocks rallying, people were still buying safe bonds.
Seems like it. Yields fell initially during Monday's stock sell-off, as you'd expect, but they stayed relatively low even as stocks recovered. Suggests caution lingered.
The bond index itself was up.
Yeah, the U.S. aggregate bond index gained about 1% for the week, a reminder of diversification benefits. Corporate bond spreads held pretty steady, too, despite the tariff worries.
Interesting. And commodities. Gold.
Gold kept climbing, hit $3,221 an ounce, up 0.7% for the week, and get this, up 19% year-to-date.
Wow. Still acting as that safe haven.
Absolutely. Trade risks, geopolitical stuff. Gold thrives in that kind of uncertainty.
But oil went the other way.
It did. WTI crude fell to $62.29 a barrel, down 3.2% for the week.
Why the drop? Weren't there supply concerns related to tariffs?
There were, but it seems like worries about global demand slowing down might have outweighed those supply fears. If the global economy slows, demand for oil drops.
So gold up, oil down. That contrast tells a story.
It often does, yeah. It can signal a sort of risk-off bias lingering in parts of the market, even when stocks are having a decent week.
How did things look globally? Did Europe follow the U.S. rally?
They saw gains, yeah. The DAX in Germany, FTSE 100 in the UK, up maybe 0.5% to 1%. They likely benefited from the U.S. tariff pause talk, too. Plus, expectations the European Central Bank might cut rates soon.
What kind of stocks led there?
Defense and infrastructure seem to do well over there.
And Asia.
Mixed bag. Japan did well. Nikkei up 2.8%. Topix up 2.7%. Easing trade tensions helped there.
China.
China's Hang Seng saw a modest rise, maybe 0.7%, but you could feel the pressure on exporters still worried about those U.S. tariffs.
What about emerging markets?
Modest gains in places like Brazil and India, often supported by their own domestic demand. But currency volatility remained a persistent issue for many EMs.
So globally, things stabilized a bit as U.S. trade fears eased, but caution remained, especially regarding China.
That sums it up well. The interconnectedness is clear. U.S. policy ripples everywhere, but China's retaliatory stance keeps everyone on edge.
Okay, looking ahead. Week of April 28th to May 2nd. What's top of mind?
Trade talks, number one. Those U.S.-China negotiations, especially hammering out details on tech and auto exemptions, that's going to drive sentiment.
And the risk of things going south if the 90-day pause falters.
Huge risk. Any sign of escalation could reverse recent gains very quickly.
Earnings season also continues, right? More big tech names.
Yes. Reports from giants like Microsoft plus more consumer firms. These will be a real test of resilience to tariff costs. Guidance will be absolutely critical.
What signals are they sending about the future?
Exactly. And we'll get more economic data, too. April employment numbers, consumer confidence updates.
Give us a clearer picture of the economy's momentum.
Hopefully, that data will influence sector rotation, Fed thinking, everything.
And any more Fed speak.
Always listening for that. Any commentary on inflation, growth risks. It shapes those rate cut expectations, which the market is still very sensitive to, especially any hawkish signals.
So it sounds like the market's recent recovery is built on maybe fragile optimism.
I think that's a fair way to put it. There's some resilience shown by the earnings beats, but volatility seems likely to stick around until there's more clarity, especially on trade.
Investors are juggling a lot. Earnings strength, economic data, policy uncertainty.
It's a balancing act. And keeping an eye on tech and financials seems key, as they've been so central to recent moves.
Okay, so recapping the week of April 21st to 25th. A volatile ride, a sharp early drop followed by a recovery. Key drivers seem to be hopes for tariff relief and strong Q1 earnings.
But underscored by ongoing trade tensions and those mixed economic signals, creating a persistent layer of uncertainty.
Right. The market's definitely sensitive, reacting quickly to news flow.
Remains a complex picture. Investors need to stay watchful.
Definitely. So here's a thought to leave you with. We've talked about this fragile optimism, the push and pull of trade news, earnings, economic data.
Yeah.
Given all that, what parts of the market, what specific sectors or themes do you think might prove most resilient in the coming weeks? Something to chew on.
Good question. A lot to consider there.
Thanks for joining us for this deep dive. We definitely encourage you to keep tracking these trends. Until next time.